going to be a more challenging time for British households over the course of this year. Real income growth, to use our terminology, will be negative. To use theirs, wages won't keep up with prices for the goods and services they consume. But I think it's important to put this in context. And the context is that the economy is still growing solidly. The economy is still creating jobs. Wages are still growing, and we actually expect that the pace of wage growth is going to accelerate as this year progresses, and certainly into 2018, 2019. And this higher inflation that we're experiencing now will come off in subsequent years. So real income growth, we expect, will return, and people will start moving ahead in the latter years of the forecast. Now, there's lots of assumptions and judgments around those conclusions, but that's our best judgment.
Chris Giles from the Financial Times. Governor, you said that the forecasts are dependent on a smooth Brexit, a smooth leaving of the European Union. How dependent are they? How much would the forecasts be worse if we didn't have a smooth exit?
Yeah. So in order to precisely answer that question, we would have had to do an alternative forecast, as you can appreciate, with some variant of a disorderly negotiating process, and we have not done that. So I can't give you a precise answer to that. What I can say is that, as has been the case since our August forecast of last year, we have assumed that the process of leaving the European Union would be a smooth one. What does that mean? That means that there will be an agreement about the future trading arrangements, and that there will be a transition or an implementation period from the negotiation to that new agreement. Now, we, like everyone else, doesn't know exactly the shape of what that agreement is going to be. That's why there's a negotiation. And so we have conditioned on a range of possible outcomes. We haven't changed those judgments, that averaging period. But what we do have is an economy which gradually adjusts to those new trading arrangements that happen at some point in the future. In other words, some point after the forecast horizon. And so one of the consequences, and I'll finish with this, of that process is there's a bit of a drag on productivity in our forecast as the economy reorients to those new arrangements. But there is not any sort of sharp break or sharper adjustment that's seen.
Ed, and then Kamal, please.
Thanks. Ed Conway from Sky News. It's kind of really following on those two questions. Can you be specific about whether this squeeze that we're seeing in real earnings that you've just talked about is a consequence, direct or indirect, of Brexit, of the referendum? And just additionally to that, we're kind of almost a year on. Other than that, can you tell us what impacts there have been or haven't been on the UK economy from the referendum vote?
Packed a lot in there, Ed. The highly efficient question there, so it's going to be a longer answer. In terms of your first question, which I'll characterize as, is the squeeze in real incomes all because of Brexit? Is that a fair characterization? And the short answer is no, because part of the story here is that wage growth has been weak. Now, wage growth has been weak for several years, despite relatively strong, in some respects, exceptionally strong in terms of actual quantities of labor markets. In other words, how many jobs have been created and hours that people are working. We've had quite a strong labor market for several years, and wage growth has been weaker than one would have expected. Now, in our last forecast, part of the way our judgment has been that actually there's probably a bit more slack in the labor market. Put in a more positive way, the labor market, there's probably more people can work more people are seeking work, and the level of unemployment the amount of jobs this economy can create in a sustainable manner is higher than we thought previously. So that's part of the answer to it. But another part of the answer is we think weak wage growth partly reflects the relatively poor productivity performance in this economy for the last several years, or since the financial crisis. Now, that predated Brexit, and actually what we have seen in the last few quarters has been some modest improvement in productivity performance. So there's two elements there of this squeeze around wages, which are predate the Brexit process. Now, there's one element which is largely the product of the decision to leave the European Union, which is the overshoot of inflation. It's because the currency went down, and the currency went down because of a judgment. I'm not endorsing the judgment. I'm observing the judgment of the market that there would be consequences for the UK's medium-term prospects, and the exchange rate needed to adjust accordingly. So that element is there. I think the related question, for which there is some evidence, we pick some of this up when we go around the country and talk to businesses, but I wouldn't say it's conclusive. There is some evidence that businesses are hesitating to bring in higher wage costs at a time of some uncertainty about market access and other costs that could be associated with the Brexit process, and that workers, that bargaining dynamic is resulting in more modest wage settlements. But we do expect in this forecast, or our central expectation in this forecast is, despite all those factors, we do expect wages to pick up, and we do expect real income growth to turn positive again over the course of the next few years, and that is during the period of leaving the European Union. So it's not as black and white. Given that I probably used up 2 minutes on that answer, maybe can I stop there? Is that all right? And maybe we'll go for other questions, and if we have time, I'll come back to your other one, if that's okay.
Kamal.
Kamal Ahmed from the BBC. Governor, you've spoken about this sharp squeeze on living standards this year. Why are you so confident that that will come to an end and that wage growth will hit 3.75%, you suggest, by the end of 2019? What are the reasons for people's income starting to rise more rapidly than inflation? And could I also ask, what preparations does the bank do for the possibility of a radical change in economic direction after a general election, for example, towards more public ownership, higher borrowing, and possibly higher taxes for investment? I just wondered what work the bank has to do on the possible outcomes on June the 9th.
Well, we'll start the work to adjust to the new government on June the 9th. So that's the answer to the second part of the question. Let me start on the first question, and I'll hand to Ben in terms of our confidence. First, it is no guarantee here. This is a forecast. It's driven off of the tightness in the labor market, which, even though we think the equilibrium level of unemployment is lower than the current rate of unemployment, we are continuing to add jobs. Average hours worked actually were quite strong growth in the first quarter. So the market's getting tighter. You pick it up in surveys, not just our surveys. You see the most recent REC survey, which was a bit mixed, but did show that in terms of recruitment difficulties, for example, skilled recruitment difficulties, that continues to be above average. So there is a tightness in the labor market. There's some catch-up to do for workers in terms of, even though productivity growth has been relatively meager, over the forecast, our path for wage growth is below our path for productivity growth. Ultimately, workers share in productivity gains, and so there should be some catch-up there. And then I guess the third point I would make, which is that, again, we're conditioning on a smooth process, smooth Brexit process, as we have been since August. That's not new. But to the extent to which that is the case, and the extent to which uncertainty over that process is temporarily weighing on wages, that should dissipate. I wouldn't overplay that point, given the conditions I put around my answer to Mr. Conway. But Ben, do you want to?
No, I think that's
expand?
most of it. One small thing I'd point out is just to be precise about wages and incomes. So real wages are falling this year. Real incomes in aggregate are not. That's because we've got some employment growth, and it's also because you've got to remember that almost half of household income is not wages. It comes from various other things, including pensions, both public and private, and those are rising slightly faster than wages. That's one small thing. The only other thing, two other things quickly to point out. One is that the squeeze that's coming from rising import prices doesn't last forever. As the governor said, we're seeing it pretty acutely right at the moment, but it does sort of dwindle over the forecast period, and that contributes to a rise in income growth in real terms. And the last point to make is about that nominal wage growth. It has been weaker than we've expected on many occasions in the last 2 or 3 years. That's why the committee earlier this year lowered its estimate of the equilibrium rate. We still think that the tightness of the labour market means something for future wage growth. So, it was weaker again in Q1, even weaker than we had expected after lowering that equilibrium estimate. But we still think that will help some recovery in the growth rate of nominal pay over the forecast period.
Sue, and then David.
Sue Chan from The Telegraph. Your forecast projects more balanced growth over the next 3 years with stronger business investment and exports. Does the bank welcome that? And to borrow the words from Ben Broadbent's speech, can this sweet spot last?
Okay. Well, I'll let Ben expand in a moment on his sweet spot. I mean, certainly it's welcome to have more balanced growth. It still has to come. I mean, this is a forecast. I'd say a couple things of context. First, we see some pickup in investment and some positive contribution from net trade for most of the forecast, but this is not. It's not booming. We have, I think, investment growth is roughly half of past averages. Net trade or export growth, kind of 1 3/4% growth. 2018, 2019. So, and particularly with respect to the latter, and to some extent the former, relatively modest given the scale of the depreciation, given the strength of the global economy, and this is a partial answer to Ed Conway's question earlier, as some of the, he's not listening now, but that's even better, so I can say I answered his question, but partial answer to that's part of the Brexit. There's a bit of a Brexit judgment there, is that for some exporters, adding capacity right now, if they're tightly linked into a European supply chain about which there is some uncertainty, makes less sense. We're not just saying that theoretically. We know that from talking to a series of companies around the country. It's not surprising. And then on the investment side, you definitely get some of that effect here. So the point I'm making is there's more balance. You're absolutely right. That is welcome. But this is not, these are not big numbers in the grand scheme of things.
No, I think that says it all, really. I mean, I think the point I was trying to make in the speech is that the exchange rate is weak in anticipation of something that hasn't happened. So for the time being, you've got, on the face of it, what are pretty propitious and helpful conditions for exporters. Nevertheless, as the governor said, allowing for the strength of the world economy, investment, the level of investment at the start of the forecast is quite low, given those conditions. And while we're expecting it to grow, our forecasts are not that strong. So there's some rebalancing.
Yeah, David.
David Smith, Sunday Times. Governor, going back to wages, the forecast that you're making of quite a strong recovery in average earnings growth does seem puzzlingly bold, given that you expect the equilibrium unemployment rate to be at or the unemployment rate to be at or above its equilibrium right through to the second quarter of 2020. And surely that is the appropriate measure of slack to take into account when you're looking for wage pressure.
Well, it's not, David, I think as you know, I mean, it's not a binary thing. We have historically, we've actually, in the UK, there's been a pretty well-functioning Phillips curve, wage Phillips curve in this economy. I think there has been a question of whether there's been a level shift given where the equilibrium level of unemployment or rate of unemployment has gone. It's a pretty well, I mean, different people can have different views, and there's certainly some on the committee who think it may be lower than where we settled. Some who think it's potentially higher. But it's a pretty well researched view when we drop the level of unemployment. But it's not as if, to get back to my broader answer, it's not as if you magically start to have wage pressure consistent with productivity growth and some productivity growth and inflation at target. Because in the end, I mean, we're talking about 3.75% wage growth, I think, by the end of the forecast. Productivity growth, a little less than 1.75, let's say 1.5, 1.75, I think, by the end. Inflation a bit above 2. Normally, when you get back into equilibrium, which is where we are by the end of the forecast, you would expect in a perfect world, and of course there's always lags and leads and things, but in a perfect world that you would see productivity plus inflation being nominal growth, so you'd have nominal growth above 4. And on top of that, there's some productivity catch-up to be done. Workers in our forecast, at least, aren't getting paid for the productivity boost that we expect, or aren't being fully compensated for the productivity boost that we expect in the intervening 3 years. It's only that they get back towards running at roughly the rate they should. That's a very theoretical model-based answer. The sort of real economy answer is actually, we've got 4.7% unemployment. We've got very high participation. Average hours are picking up. We're seeing some recruitment difficulties. There's a variety of reasons to expect wage growth to be stronger. There's some inertia in that market. There's some historic productivity weakness, and there may be some uncertainty effects that are weighing on it as well. It's also possible the equilibrium rate of unemployment is a little lower. I'm not saying that, but it's also possible. We'll have to look at it over time. But there should be some build, and whether we have it precisely right, time will tell.
Hugo, and then Phil.
Hugo Duncan from the Daily Mail. Governor, you've spoken about the impact of the exchange rate on inflation. I wonder what impact you see the oil price having on inflation and the recent falls in the price of crude, and how that might affect the squeeze on finances, family finances this year.
Yeah. Well, it's always dangerous to update forecasts in real time because Brent will be below 50 and then above 50 in the course of the week. I think rule of thumb, it's about probably relative to the closing of the forecast to the trough of the oil price, which was sort of 8% off or so. If I'm going from memory in terms of the conditioning assumption, it's probably 0.1 off. I think the important 0.1 off inflation sort of out to a year. And I think one of the important things to think is, so that, that's something, and then also there's an exchange rate effect, which again, it has to persist, and also the curve's a little steeper, and all these, you could always update the forecast, so you don't want to get too much into it. On the oil price, so there may be something given back from the oil price if it remains at a lower level to British households. From a monetary policy perspective, that's likely to come through relatively quickly and not over the policy horizon. So it's interesting, it's welcome, but it's, and I'll make one other point actually, which is since it would appear to be supply driven, if it does persist, is actually stimulative. But obviously we're not banking on it. We'll deal with it in August if it persists. And it also doesn't really shade policy because you're reacting to something that happens you would be reacting to something that's over by the time the full force of your policy move takes effect. Okay.
Phil, and then Ben.
Phil Aldrich at The Times. Governor, inflation is above forecast. UK is at full employment. We've got economy growing at around trend rate. The output gap is closing. I just wondered how you can justify excessive stimulus at these levels, and what does it take for the bank to raise rates? Are you simply worried that households just can't stomach a rate rise?
Well, first off, where to begin on that? The stimulus isn't excessive, it's appropriate, first point. Secondly, and that's the judgment of the committee, secondly, the inflation is above target. Why is inflation above target? Inflation is above target because the exchange rate went down 16%. Why did the exchange rate go down 16%? Largely because of the decision to leave the European Union. Okay, that's a market judgment. Not endorsing the judgment, but that's the market judgment. That's a flow-through. Question is, do we lean against that and lean against something which has a real underlying fundamental aspect to it, something we can't affect? We're not changing monetary policy is not going to change the future trading relationship between the UK and the European Union, or the UK and other countries. Those decisions are going to be taken quite appropriately by governments. In terms of the economy is not at full employment. The economy is above full employment. And the output gap, part of the reason, to loop back to the start of my answer, part of the reason why the output gap is closing over the forecast is because monetary policy is appropriate. Now, we have said that we used a conditioning curve for the forecast, as we always do with convention. We used to take a 15-day average at the time we freeze the or finalize the forecast. In that curve, there was one 25 basis point hike in interest rates over the course of the next 3 years. Judgment of the committee was that that's if the forecast is coming to pass, that's too little, and that we would, if things unfolded as per the forecast, you would expect us to withdraw some more monetary stimulus over the course of the next few years. But that's withdrawal of stimulus or raising of interest rates, to be precise, to a modest extent in a positive economic environment where the economy is growing above trend and we are closing the output gap.
Ben, and then Jim.
Ben Chew from The Independent. Governor, once you've revised down the savings ratio again in these set of forecasts, and you've put a technical annex sort of suggesting why that isn't quite possibly as alarming as it might look. At the time of the March budget, your former colleague, Sir Charlie Bean, struck a very different tone. He said that the falling savings ratio, he highlighted the fact that in his view it wasn't sustainable. Not sustainable is his view. Do you disagree with that, or is it a question of nuance? What's going on?
Well, I'm going to allow my current colleague, Dr. Broadbent, to discuss the nuances of the saving ratio, and I'll just preface it by one's got to look at a difference between, there's the direction of the savings ratio, there's the statistical reporting of the savings ratio, and there's the cash and non-cash elements of the savings ratio. All of these are relevant. And it takes a very special and to some extent sad individual to be fully versed in all aspects of it. And fortunately, we have one here today. Ben.
No, I'd make a distinction as well between the level of the saving rate, and Charlie may or may not have been talking about that. I suspect he was talking about the decline in the saving rate. And there's no doubt that to the extent it's true, and I'll come back to that in a moment, that the saving rate was falling in the second half of last year, from whatever level, that's unlikely to be sustainable for very long. Indeed, in our forecast, it's sort of roughly flat. When it comes to the level, unfortunately, it's very difficult to make a judgment, even in normal times, I would say, or most of the time, because the level is often revised. And what we alert people to in the box, page 16, is that we know we're going to get quite big revisions later this year in the Blue Book, which will generally be upwards. And those might also change the slope, the recent slope. So I completely agree with Charlie. You're unlikely to see, in the end, this thing can't fall forever. And if you get a period in which it falls steeply, then you can be pretty sure that it's not going to carry on doing so for very long. When it comes to and that's the case in our forecast, it sort of flattens out.
Yeah.
When it comes to the level, though, I'd be very wary about making judgments about what is or isn't sustainable, not least because we can't be really sure in real time what that level is.
And may I just supplement final thing, which is to sort of link some of the questions in your question, which is the forecast does rely heavily on a recovery of wages, a pickup in wage growth. So it's not a forecast where consumption is softer and then sort of U-shape consumption over the consumption growth over the forecast. And it's not a forecast that relies on, it's not a debt-fueled consumption boom, is my point. It relies on wages. It doesn't rely on the savings rate going to zero and negative. And so it's, obviously, people can ask whatever they want, but it's entirely appropriate to focus in on what is happening with wages, what can be expected to happen with wages over the course of the next few years, because it's absolutely one of the key judgments. We expect wage growth to pick up. If it doesn't, it has consequences.
Chairman.
Chairman Acton from CNBC. Governor Carney, you've spoken in the past about the threat of automation, and I appreciate that this is a secular trend,
right,
but it's one that's arguably accelerating and a potential paradigm changer. How do you reconcile this with such a buoyant view of the labour market going forward?
Well, it's a couple of things. I mean, it is something we do look at secular trends because there are a few from time to time, and one can think of China's integration to the global trading system as being a classic example of the previous decade. There are a few secular trends which actually impact consistently on inflation prices in this country, and therefore monetary policy has to take into account. It is possible that at some point automation, use your term, machine learning, other terms, that will have those impacts in the UK. It's possible. It's not yet clear that that is the case. And what is clear is that the UK labour market, to use your adjective, has been buoyant. It has been very strong. This is the strong, there's more people employed in this country than ever before. Employment growth continues to be strong. As I said in my remarks earlier, average hours growth is not just jobs, but the amount of hours people are working has also picked up smartly. And again, in terms of the pickup in wage growth, this is not, yes, it is faster wage growth by the end of the forecast, 3 3/4% than we have been seeing. It's not especially fast wage growth. I would keep that in mind as well. So your question's on point. It's the type of thing we think about, but I wouldn't say that we're in a period of time, and you can just see that from actually the employment numbers, where there's wide-scale displacement of work as a consequence of these bigger trends.
Richard and then Simon.
Richard Barley from Wall Street Journal. Governor, the bank sounds quite upbeat about the prospects for global growth. Could you just talk a little bit about the risks around that, the way markets are responding to it, and perhaps also the balance between stronger global growth and tighter monetary policy around the world? Sure.
In terms of risk to global growth, we have I would say there's a slight skew to the downside net on global growth. Now, that's starting from a position where we are near the top of consensus in our global forecast. That was the case in February. We've upgraded a bit more this time around, so we remain there. So again, I put it in context. One of the medium-term risks, and of course medium-term risks are always medium-term risks until they crystallize, and then they're all of a sudden near-term risks, do relate to the rate of growth in China and the adjustment and the necessary series of adjustments in that economy, which are from the manufacturing to services sector, from external demand to domestic demand, the shifts that are necessary in both the property market and very much in the financial sector, and some of the pressures that exist in an economy that has very, very high levels of private debt. None of those all of those issues are well known to the Chinese authorities, and they have plans and put them in place, and we've seen some moves in the recent weeks consistent with those. So that is one of the bigger risks. in terms of, I mean, I won't presume to make any judgments about other people's monetary policies. I think the thing to watch for all of us in a global context, and very difficult to, you can have lots of false precision about this, and we wouldn't presume it, is that and if I'm going to finish with a sort of positive global scenario, which isn't assured by any stretch, but in a positive scenario where you have broad-based growth, it becomes the levels of uncertainty coming down. And if we start to see a pickup of investment, private investment relative to savings, there could be some upward pressure on global equilibrium interest rates, which in and of itself will give monetary policy more traction on unchanged policy. And that's something to watch for over the horizon, and it affects all of us. The one last thing I'll say on that, though, is that I think we should all remember, and the bank, colleagues at the bank, Rachel and Smith, have done a lot of work. I would recommend it if you haven't seen their work, that decomposes the effects on equilibrium real interest rates. I mean, R-star, use the shorthand. And the bigger effects on that are broader forces, demographics, other forces, than just the savings investment, the investment stance per se. But with that caveat, one could see a rise, and one would hope to see a rise in R-star over the course of the next several years, which has some consequences for the path of policy.
Hello, Simon Viger, 5 News. Governor, you said that hopefully next year or the year after wages will catch up. In your view, is that going to be anywhere near enough for people who are struggling to make ends meet right now?
Well, it's, I think the first thing is to recognize that, you know, the economy is starting a period of adjustment. And the first thing to make ends meet is to have a job, and so part of this is making a judgment in exceptional circumstances that we're in, that we have an appropriate stance of monetary policy, so that people are in work first, and as many people are in work as possible, and that's why we are tolerating this overshoot of inflation. Because the origin of that overshoot is the exchange rate, and the origin of the exchange rate move is this future adjustment to new relationship with the European Union. So first and foremost, we make a conscious decision, at least for a period of time when there's a trade-off between people being in work and inflation being a little higher, it's better to have people in work. You know, obviously, every household situation is different. It will be a more challenging time over the course of this year, but it is a time where we continue to see, in our view, job creation and the prospect of wages picking up, and this higher inflation is temporary. It is temporary. So I think households can, well, I would put some store on that, but I wouldn't diminish the issues that some people would be facing. Yes.
Holly Williams, Press Association. Looking at the pound, given its recent rebound since the snap election was called, do you think that this means the worst is over for the pound in terms of the falls that we saw? And also, this recent rebound, how much has this limited the surge in inflation in your inflation report today?
In terms of the second aspect of that impact of sterling on,
Well, it's not. It was up 3% since February, so it will have had at the margin some depressive effect on inflation towards the end of the forecast. It's still the case, as the governor pointed out at the beginning, that the reason for the overshoot relative to target essentially is still that import prices, even at that stage and even after sterling's rise, import prices are rising faster than usual and pushing up on inflation at that horizon. But yes, it would have been slightly less marked than was the case 3 months ago, that effect.
Good afternoon, Governor. Harry Daniels, Live Scorp News. The tone today seemed to be a bit more upbeat and optimistic from the MPC statement on the state of the UK economy. With that in mind, one part of the question was, have the markets fallen behind the curve in terms of rate rise expectations? And from the MPC's perspective, is looser for longer a less risky option than a premature withdrawal of stimulus?
Well, first, Harry, from the MPC's perspective, at least in the judgment of 7 of the 8 members of the MPC, the current monetary policy stance is appropriate to achieve our remit. The second thing, though, is that look, we will. The committee will set the, as you would expect, we're going to set the appropriate stance of monetary policy to balance our remit under exceptional circumstances. I think one thing I'd sort of dispel, that the Article 50 process, the negotiation process, it is that process and that end state, of course, has an influence on the economy and inflation. But it does, and we have to take that into account and set monetary policy appropriate, and that's what we're doing, and we're explaining it as best we can. But it does not tie the hands of the MPC. The MPC will take the necessary monetary decisions at the appropriate time in order to get that balance right. Now, what we said with, and just by one way of illustration, with this forecast, is that we have, in our best judgment, if the market, if we followed a path consistent with the market curve at the time we made the forecast, I know that's a mouthful, but which basically was 125 basis point rate increase over the next 3 years. The judgment of the MPC is that inflation would not be returning sustainably to target. In other words, it would have come down and then would have picked up, and domestic costs would be building. And for that reason, we would expect, if the economy were on that path in broad terms, that we would withdraw some more stimulus over the course of that time. And of course, over that period, that's still during, or 2/3 of that period is still during the Article 50 process as defined in the treaty. So I guess I would just use your question as an opportunity to make that, which I think is a pretty basic point, and a point that most in, you asked the question from a market perspective, most in the market would appreciate.
Hi, my name is Matthijs Schiffers from the Dutch Financial Times. Theresa May wants to reduce immigration to below the 100,000. That might make the labor market even tighter than you expect now. At the same time, it may dampen growth. Do you take lower immigration into account, and to what extent?
Well, the first thing is that what we do for our forecast is we take the estimates of the ONS for net migration into the country, and we just, they're the experts, they make the estimates, we take them, we port them in, we use those. And so we don't make an independent judgment about either future government policy or the effect of future government policy. The second thing is that I'll get my dates wrong, but I believe it was November 2015. It might have been, it was in 2015 in a similar report. We did an analysis of the effect of change in labor supply on wages. And you go up and down by, I think we used 100,000 as normalization. We can get you the background. The point is that, the effect of labor supply on inflation, which in the end is what we ultimately have to worry about. And changes in the overall level of labor, whether they come from domestically more people coming into the labor market or net migration. Most migrants, the labor market outcomes of migration are similar to domestic workers. They're a little higher, actually. It's a relatively modest impact on inflation, around 10 basis points, order of magnitude. And the reason it's that is that you supply more labor. It has a dampening effect in the labor market, but then there's more demand, and that has a tightening effect on prices and wages, ultimately cycles through the economy. So that's all. I can understand maybe in the Netherlands, who didn't follow this as closely. That's all sort of old news. So we just take a specific forecast of somebody else about net migration, just use that, and then separately in terms of the overall shifts and the impact on what we care about, what we're mandated to care about. Obviously we care about labor market outcomes, but what we're ultimately, our ultimate remit is it's a relatively small effect. Last thing I'll say, obviously for certain sectors and areas can be incredibly important, but there's a process which others run for those areas to make their views known to the government.
Jill Ward from Bloomberg News. The inflation report mentions that certain measures of domestically generated inflation are starting to pick up. How much weight do you put on those at the moment? Does that make the overshoot in inflation harder to tolerate? And also, could you elaborate on how they're expected to pick up as the inflation report says near the end of the forecast period? Thank you.
Okay. So we look at a range of domestic DGI measures, domestically generated inflation measures, and there I think we list at least we list some of the summary in the report, as you note. The first thing to say is that it's actually hard to get a pure domestic measure, which is part of the reason why you look at a range. When you look at them as a whole, they have been relatively subdued. If you look at they picked up in recent quarters. If you use, for example, a principal component, which is a way of extracting the core message from a series of indicators, a statistical technique. If you look at the principal component of those DGIs, they are still below levels that are consistent with inflation being at target. But why is inflation above target? It's above target because of the exchange rate, et cetera, what I've been saying. We do expect them to pick up, as you note, over the course of the forecast horizon. So the drag that they're exerting on the rate of inflation diminishes over the forecast horizon. It doesn't fully extinguish by the end of the forecast horizon. It's still a very modest amount by the end of the forecast horizon. But virtually, you can see that we would expect that them to be consistent with target as a whole. But
yeah, it comes back to this judgment on wages, essentially, and I think that's what's necessary. And in the forecast, at least, the key measure of domestic costs that drives that are unit labour costs. So it requires that wage growth pick up, and in particular that it moves above the rate of productivity growth.
So, and maybe I'll just make a general point, which is that if you like the look of the forecast, and we're not marketing it, but if you like the look of growth, the rate of growth, and the employment performance in the forecast, we're going to see a period where we're starting to see domestic costs pick up, wages pick up, unit labor costs pick up, other domestic measures pick up, when inflation is still above target. Still above target, again, because of the exchange rate. That's a good outcome. That is a good outcome. That's what we want to see, is that we start to get that domestic traction, reflation, if you will, domestically, as the external side is starting to come off. And obviously we have to calibrate monetary policy appropriately during that period. But that is those are positive developments for the sustainability of this expansion.
Ivana Esterhazy from German Business Week. You said that your assumption that your forecasts were based on the assumption of a smooth Brexit, including a transition period and so on. I was just wondering if this assessment is a bit optimistic, given that Mrs. May seems to be heading for a hard Brexit, and we've had various statements from the European Union and also reports about this infamous dinner at Number 10 recently. And what would it take for you to, change your assumption, to adjust it?
Yeah. Well, I think the first thing is that the stated objective of the UK government, of the Prime Minister, is a bold, comprehensive trade agreement between the UK and the European Union, and furthermore, that there is a period of implementation, appropriate period of implementation, to go from where we are today to that agreement being in place. And you know, the stated view of President Tusk on behalf of the European Council is that it's in everyone's interest to avoid a disruptive or disorderly process. There are negotiating mandates, well known, public negotiating mandates for Mr. Barnier and for the other principles that are consistent with a process that will lead to an agreement. So that is the objectives of both sides, and it's not our place to call those into question. There's also, as I think we all know, it's you know, we haven't between now and March 26, 2019, for these negotiations to get underway, and it's very early days in the whole process.
Jasper Jolly from City AM. With volatility on markets around the world at kind of historical, well, pre-financial crisis lows, and markets at kind of record highs, do you think there are risks around your forecasts if markets pull back from some of these highs and volatility rises?
Yeah. Well, the first thing to say is that volatility is, as you rightly point out, is quite low across a range of financial markets. In sterling land, actually, and particularly in sterling, volatility is probably closest to its historic average, its 5-year average, than any other currency pair, with maybe the exception of the Canadian Aussie dollar, may be up there as well. Now, there's a variety of potential reasons why volatility would have been reduced, and those range from in the broad, you know, the phase in the economic cycle we are, where it's a broad-based acceleration in the global economy at a time when we're not seeing the inflationary pressures. Range from that to improvements in the resilience of the core of the financial system, to potentially volatility strategies or yield-enhancing strategies of real money investors selling a lot of volatility. That's a more market technical thing. But I would not say that we would have a complete explanation for why volatility is where it is, nor would we make a specific prediction about when it would necessarily adjust. But yes, I mean, there is one would expect the world hasn't become dramatically less uncertain, and certainly can see some potential triggers for increase in volatility at some point. Now, how will that affect the UK? One of the things we do at a different part of the institution is to make sure that actually the core of the financial system is managing its risks for a much higher level of volatility, credit spreads, other actual credit losses. And we do that through stress testing. So that's been core to our stress testing approach, and we feel reasonably confident that they're in a good position for that. So that's one way to mitigate it.
And we're out of time, I'm afraid. Thank you very much for coming, everyone.
Thank you.